I'm Justin Reid. I'm the CEO of Troilus Gold. We're a $180 million gold and copper developer in Quebec, developing the Troilus Gold Mine, which we hope to deliver a long life, 25-year plus open pit gold and copper mine, producing about 250,000 ounces of gold a year and 25 million pounds of copper.
Justin, good to see you again. Picked up the news release you put out. Super high grade stuff coming out of the backyard at the moment. But I want to tap you up, if you don't mind, using some of your kind of experience from the street, okay? Because the market is getting confusing for a lot of retail, getting lots of questions in. What is going on? We're seeing companies not struggle to raise money. They can get institutional money for projects, no problemo. The difficulty or the disconnect seems to be retail extremely nervous at the moment. So the liquidity isn't there for some of these companies. We've seen them come off the last 3-4 weeks. What's going on? Have we seen it before?
Yeah, I mean, I think we've seen it 3 or 4 times in the last 10, 15 years. We go back to the kind of fear and fame, debate. We're looking at, and I'll talk about gold specifically right now, and the copper producers as well. We're looking at Newmont and Barrick, and in the copper space, First Quantum. Everybody's hitting all-time highs. 52-week highs. We're still in $1,900 gold environment. We're still in a $4.50 a pound copper environment. They're making real money, and balance sheets are looking great. A lot of the mid-tiers are staying strong despite the pullback, but there is a flow of institutional capital to producers because of strength, I think. Balance sheet strength, dividend strength, or expectation. But the gap is widening right now, and this might be the opportunity between the explorers and the developers and the producers. And it is likely, despite the capital being available, the cost of capital is increasing. Equity prices are going down for the developers or staying flat, so there's dilutionary issues, and it's kind of in this face of all these capex is blowing out everywhere. And I wouldn't even say blowing out, I'm just saying adjusting to the real world, right? And then the sticker shock that comes with that sometimes. But you're going to see catch up. If we use other markets as a proxy, Australia is about 5 months ahead of us with cash going into that space. We're now starting to see a new flow of funds coming into that space. And those companies, and we're lucky enough that have some liquidity and they're trading, you're seeing flows of funds coming in. You have to have a buyer for every seller. And the volumes across our space are going up, which is a really, really good sign. We're seeing redemptions from the funds, the smaller capped funds start to slow down and inflows happen again. So, yeah, I think we're turning the corner. I'm not banging the table, say buy Troilus, but I think the space is a great period to enter from a portfolio standpoint if you have a reasonable window, 12 to 36 months.
Yeah, I mean, if I look at this opportunity, there are a lot of parallels to me from March 2020, right? There was a massive buying opportunity. We definitely took advantage of that situation to a lesser degree now, but it's definitely a buying opportunity. But what I'm trying to understand is why the institutions, well, clearly they'll be piling into the producers because they're throwing off cash for fun at the moment, and near-term producers, some of these advanced developers, likewise. But retail at the moment is looking in at the space and saying, I'm not sure where this is going. I'm nervous about my cost base going up, energy cost, food cost, everything I do cost. Salaries not keeping up and in line with that. So the kind of disposable income component, and then to a lesser degree, the discretionary spend, where that goes. There's some real nervousness about explorers and developers at the moment. So what would you say to like, for me, I think it's a massive buying opportunity, right? And I'll kind of spread it across my portfolio, but exploration and developers with strong fundamental stories, it makes sense. What would you say?
I would say I appreciate that fear, first of all, right? Interest rates are going up. The housing market in North America is kind of leveling out, so it's not upward and onward. But what I would say is if we step back and we look at the major producers, they're making lots of cash. What are you going to do with the cash? reserves are getting exhausted and not replaced. Anecdotally, we're seeing the quest for assets kind of hit an all-time high as far as not just Troilus, a lot of my peers that I communicate with. There's a lot more interest in where are we going to buy the next ounce, or how are we going to get the next ounce? And you can either do two things. You can find it or buy it. And so from the developer standpoint, I think that capital invested today is in very, very good hands. I think you're going to be very well protected because good assets are going to move forward. They always do. And right now, there is, especially when you start looking at copper, which Troilus has a lot of, the non-precious metals, you start looking at lithium, zinc, nickel. These are all strategic metals that are becoming more and more important and more focused. So 100%. Look at, say, I'm going to give one example. Sayona Lithium in Australia, which I think is a fabulous company. 2 years ago, if they were on your show, they were a $15 million market cap. Today, they're a $2.7 billion company. What did they do? They consolidated Canadian Lithium. They're going to build these things. It's going to cost them a couple $1 billion to do it, but they're not making it anymore. So you have to find the assets. So for me, it's about buying assets right now.
Absolutely, but I want to come from my perspective, right? Retail investment, right? What are the clues that we should be looking for? Because if I go back to my banking days, when we funded projects because we believed that actually getting into production, we're not doing it to pick up fees, much as that maybe the thought for a lot of retail.
Yeah.
It ain't about fees. We can't lose the kind of the capital on projects which don't work. So, if now as a retail investor, I see companies that get funded, i.e. not even pre-capex, are getting funded by institutions, that's a sign. That's a signal that that company has strong fundamentals that the street, the financial institutions recognize and value. So is that what I should be looking for? And if so, what else could I be looking for?
It's really a checklist of investment, right? So jurisdiction, do you have safe jurisdiction where you can build a mine and there's a history of tenure? Capitalization. Does the company have money? Do they have enough money to execute the plan? Do they need to raise money right away? If they need to raise money right away, do they have that institutional support that takes the pressure away from the retail investor? You're not going to rely 100% on retail. And who are their institutional investors, right? Are they known to be there for a long term? Are they there to support, not for one deal, but for 3 or 4 deals, whatever it takes to build the mine? And scale and size of asset that has impact. There's lots of little assets out there that will come and go with the volatility and the cyclicity of a market, but size and scale moves forward. So that's it. For me, it's just kind of an asset checklist, and can the team do it?
You say that, right? Jurisdiction, right? We've seen in Mexico, a lithium company get nationalized. There's lots of that sort of conversation makes the market nervous. You've seen instances in Brazil, copper projects not getting their the permits and licenses through that they would have expected. You've seen long delays in Chile. And these are good mining jurisdictions with long history of mining, right? Yeah. And even in Canada, in some provinces, it's harder than others. Quebec, where you are, not such a problem, very supportive, not in terms of licensing and permitting, but also capital invested as well. So I get that. But it seems with Russia, Ukraine, obviously jurisdictional risk is being looked at differently. People have always quoted this kind of, we're a tier 1 country, a tier 1 province, etc. Those things have changed because of the rise of conversations about nationalism, First Nations, Indigenous populations, NGOs, etc. The rules seem to be changing, and it makes it hard for us to go, do you know what? Great jurisdiction. Shouldn't be a problem. I don't even think I've got to look twice these days.
Yeah. I mean, there are some unbelievable assets in Burkina Faso. And at one time, it was the market darling to invest, and we all know what happens there. It's about how safe is my dollar with that asset and in that place. And so I'm biased now, obviously. I'm talking my own book in Quebec. But previous to this, we were building a mine in Peru, right? And Peru socially was really, really difficult. And then a good friend of ours and yours, Alex Black, bought us. And, Alex did a fabulous job, and Alex did a great job, just like he is now, because Alex knows how to operate there. He has social license. He has a track record. And so I think that's the other part of is, does that team have a track record of working in that jurisdiction? Because the relationships will be stronger. A new company popping up and jumping into wherever without a history in that space, it's a lot more difficult.
Yeah, it can be. And this isn't the forum, I guess, for going through your checklist, but the nuances are there. I guess it ultimately comes down to, do you believe the management team do what they say and say what they do? Truly. Look, let's go back to you. Press release came out. I was kind of a little bit stunned, actually, because 92 grams and 68 grams over a meter, or 3 grams over 15 meters. That's not what we've seen from you. What's happening down there at the gap?
Two things out of this press release, and I enjoy coming on and kind of continuing these updates. So if everybody remembers, the Southwest was discovered 2 years ago, brand new discovery. We drilled 8,000 meters to find 600,000 ounces at surface. Put that into our PEA. It was an inferred resource. Had no idea how big it was. We've now drilled 150,000 meters into this thing. It's over 1.8 kilometers long and 600 meters wide. Now, it has a bigger footprint than the J zone in Southwest, and that's where 2 million ounces was produced. So this drilling, we kind of announced two things in this last press release. The first thing was, the margins of the Southwest are continuing to expand. I think we expanded it upwards of 900 meters. And we had some really high grades. We had, like you said, a meter of 92, a meter of 68 grams, spectacular. Thin meter intervals. I like the 3 of 15 a little bit better, but it's within the broader packages continuing. And when you go up to the J zone and you look how that was mined, there was always positive grade reconciliation associated with these later higher grade cross-cutting veins. And what we're seeing now is 8 kilometers away, this high grade vein swarm continues across the ore body. So very optimistic. The deposit keeps getting bigger down there. And now we've moved into this gap zone. And the gap zone, and I know everybody has a gap zone, but ours is a real one. Between 87 and Southwest, we have about 2.5 kilometers now. Had never been drilled. We drilled a couple holes right in the middle, really just to test stratigraphy, just to see, does this geochemistry and geophysics actually mean we have a connection of these two deposits on the kilometer scale? And, it kind of does. I'm just flipping through here. We had 7 meters of 4 grams. We had 16 meters of a gram. And these were stratigraphic holes. They weren't targeted at, let's extend this ore body. We're like, let's see if it's there. And so right in the center, we essentially proved this thesis that, the mineralization is there. I can't say it obviously connects yet. We've stopped all the drilling for our pre-fees. We've hit our cutoff. All that's in the lab. We're getting really good turnaround in our lab time now. I know some people aren't. We're getting about 21 days, which is spectacular. Best we've had in 3 years. And we've moved all 4 drills onto the gap zone. So we're going to do an 11,000 meter program right now. We're about 5 holes into it, and we're going to really give it a test. And so I think that's something that while we're engineering and while you're seeing the resource and the pre-fees and everything that's still on track for mid-July or for early July, late June, there's going to be more exploration. And then we go back into the field. So
tell me this, though, right? You don't need more. You got scale. You don't need more ounces. Yep. You need more economic ounces. I presume that's what you're going for. And if that's the case, clearly I don't think the PFS will necessarily reflect that, because you've kind of cut off the drilling for that. But what could it mean for the next economic study, for the
Sure.
DFS? Would it change plans? Could there potentially be wholesale change in terms of the way that you come at the land package that you've got?
You know what? Great questions. The first thing you have to do is be very, very careful on changing your pre-feasibility too much, because you are permitting an operation, right? And the moment you make a change within certainly the Canadian system, once you change, you kind of got to go back to the beginning of a lot of the permitting process. So you want to keep your scale and scope clean or unchanged. However, we are permitting the entire gap zone as part of our operation. So it is going to be permitted without a resource. Basically, it's going to be a disturbed area. So as we get into production, we can amend things. And when you start drilling 7 meters of 4 grams in a 0.9 ore body, and that you can build a small resource around that quickly, we'll have it within our permit. So the opportunity to increase your cutoff grade, selectively mine higher grade early, if it fits within the mine plan appropriately, is there. And what you'll see in our pre-feasibility, as maybe a little sneak peek, is I think we're going to be able to go after higher grade for the first 3 or 4 or 5 years. And if we're able to do that, don't have the fun. It drives your NAV, it expedites your payback, and it takes a lot of pressure off. So yeah, the opportunities are there, and I think we're covering it as an insurance policy by permitting the entire thing.
Right. So because
we still have to find it.
Well, exactly, right. Okay. So I was going to say, obviously, you had 5 drills on it last year, and you talked about moving, now the PFS cutoff has happened, moving those 4 drills over here. So how many drills are you going to be putting in the gap this year?
They're there right now.
Right. Okay.
There are 4 there right now, and we're probably going to bring 1 more in.
Got it. So back up to 5. Right. And can you explain to me the difference between when I've seen companies get into trouble in the past because they've gone on high grade at a project. They've kind of really screwed up the way that they manage the ore body because they're desperate for that money early. You have a job to do, say, which is like, we can get some cash in by going after the high grade stuff for the first 4 or 5 years, but the rest of it still stacks up, and we've reduced the cost of capital by bringing the cash into the company, but the rest of the ore body, which is a lower grade, is still economic. I mean, do you know? There's a conversation there, right?
Yeah, it's working capital management at the end of the day, right? You run out of working capital, you're in trouble. And I think most juniors, and even majors in some cases, if they don't have a balance sheet behind them, they mismanage their working capital, they don't mismanage their mine. You just run out of the ability to pay because you're not bringing enough cash fast enough. Troilus is such a huge asset. In the cases you explained or the example you gave, you're right. You high grade early at the sake of the mine plan sometimes, and at the sake of what's after. So you're not able to get back to that median grade that you're expecting in the life of mine, and you're in fact, you kind of go from boom to bust because you're mining lower grade than is economically viable. Troilus is going to be a little bit different because we're such a large resource. We're going to have 3 production centers, and the mean grade is the mean grade. Even if we go after slightly higher grade, and when I'm talking slightly higher grade, I'm talking the difference between 0.8 and 1.1, not huge, but 30%, we can immediately go back to the mine grade, right? We're not decreasing the available material. It's there. So, what you're talking about usually happens, especially in kind of lower tonnage underground operations where you don't have a lot of mobility, right? In big open pits, especially like Troilus, where we have 2 other pits that are there, we're going to have that flexibility. And flexibility to a mine plan is key.
Okay, great. So how many meters are we going for with the 5 drills?
A quick 11,000. We're probably halfway through that.
Okay.
But like I said, the drills are never leaving Troilus, right?
Okay.
So once that program's out, we'll probably move them back to the other side of the southwest and up to J. And we have some great targets regionally that we have a budget to test. And so we're going to finish up the geophysics right away on some of these regional targets like Distard, which we've talked about previously, and we'll get some drills over there.
Okay, like you've always told a great story about the fact that the Quebec government is very supportive. They've invested equity. They've given you other kind of credit facilities. So that's all kind of good. But the market wants to hear a slightly different story, which is, hey, this thing is going to be producing cash by X date. Given the shenanigans and the machinations of the market at the moment, has your thinking changed about the way you approach this? We've seen some CEOs try slightly different approaches because they're concerned about inflationary costs on capex. We've changed their kind of their plan of attack. Are you like-minded, or do you think that the plan A still works?
I think plan A has to work. These low-grade bulk tonnage deposits, there's a reason they're producing 30, 40, 50 detour 65,000 tons a day, right? It's all about scales of economy, and if you don't hit the scale, you're going to fail. Perfectly honest, Troilus doesn't work at 15,000 tons a day. It will be a 0% IRR. So you need to produce over 200,000 ounces a year to really drive that return. And we've always known that. Now, we have done all the trade-off studies. We have run every tonnage combination, and you'll see a 35 to 40,000 ton a day operation in our pre-fees and in our feasibility, and that's what's in our project description, because that optimizes the infrastructure that we have, which we want to take advantage of. That helps negate this inflationary pressure that we see at all these new builds, especially our power infrastructure. If we were to go to 45 or 50,000 tons a day, it's a step change in capex. You go from one SAG mill and 2 ball mills to 2 SAGs and 4 ball mills, and all of a sudden your capex just goes to $800 million. So for us, it's about optimization of using the infrastructure that we have, but it has to come at a certain scale. So it's a very fair comment.
Okay, so at $1,750 gold, there's a $3 billion pre-tax cumulative cash flow, currently payback 2.6 years. The recent drill results will only marginally affect that, but it does help with immediate kind of management of balance sheet. That's all you're trying to achieve.
100%.
Got it. Okay.
It helps us optimize a mine plan.